The US bond yield curve. Yeah, this thing sounds like some pretentious economic theory, but in actuality is one of the most accurate predictors of a coming recession. Even the Federal Reserve acknowledges as much, which is the difference, of course, in interest yields between short and long-term US government bonds. Now, under normal market conditions, the yield curve goes up and to the right, okay? Meaning interest rates or yields are lowest with the short-term bonds and they rise as the terms of the bond lengthen. So you get less on a 3-month versus a 30-year. And that all makes sense. If someone is going to lock up their cash for a longer period of time, then they usually should acquire some kind of better yield or compensation for that time. Having said that, this yield curve sometimes flips, a phenomenon known as yield curve inversion, something you've probably heard a lot about on your timeline, to be honest. Yield curve inversion happens when interest yields on shorter term bonds are higher than those on the longer term ones. The curve goes down and to the right, okay? Now, the yield curve is typically tracked by looking at the spread between the 10-year and the 2-year US bond yields. The spread is derived by subtracting the 2-year yield from the 10-year yield and plotting that over time. So here's the US 10 and 2-year yield chart since 1997. When the blue line is above the zero, that reflects a normal yield curve and normal economic conditions. But when the line is below the zero, that shows an inversion and basically abnormal economic conditions. Okay, still with me? Good. So now answering why yield curve inversion happens, it's not easy. Okay. In fact, economists admit uncertainty about it. So this is something they kind of nerd over and debate about. Nerds. Anyway, if we go back to Bonds 101, we can get some insight into the why question. Remember, government bonds are traded on the open market. Therefore, their prices and their realized or effective yields are subject to the supply and demand gods. The rule is this: higher demand equals higher prices, which equals lower yields. Lower demand equals lower prices, which equals higher yields, essentially. So if long-term yields are lower than short-term yields, that ultimately means there's a greater demand for the long-term bonds. And why would investors be moving into long-term bonds so hard that the yield curve inverts? One reason: security. Demand for long-term bonds can increase when there's a sense of economic uncertainty or instability, or if investors believe that an economic slowdown or that a recession could be on the horizon. You see where we're going with this here? Okay. Recession. I know. Oh, Lark's making a FUD video again. Look, I think it's really important to understand this whole yield curve thing and how it works. I hope that you agree. I hope that's why you've watched so far into this video, because a lot of BS out there about it, and we need to understand it. Now, look, a recession is defined by 2 quarters consecutive of GDP contraction. Technically, the US had one of those in 2022, but we'd ignore that one. Anyway, here's the yield curve plotted against every US recession since 1980. Every time, and I repeat, every time the yield curve inverted, a recession hit near the tail end or shortly following the inversionary period. Here's the 1980 and 1982 recessions. Both hit during the tail end of the inversionary periods. The 91 recession hit 3 months after the yield curve normalized. The dot-com recession, it hit 2 months after normalization. The 2008 financial crisis recession, this one hit 6 months after normalization. The indicator apparently even knew that freaking COVID would get leaked from a biolab, whatever, you know. Here you can see a tiny inversion print in August of 2019, just 5 months before the short-lived COVID recession. Interesting, right? Now here's where we're currently at. The yield curve has been inverted since July 2022, but we are trending up and trending up quickly, dang close to hitting the normalization right now. By the time you watch this video, it might have already even happened. Also, as you can see, we've been close to uninverting 2 times already this cycle, but both of those times failed. And while we're very close now, it might not happen. Or if it does happen, it might go back down. Okay, nothing's for certain, and no indicator is for certain either. I think that's important to remember about the yield curve. Just because it has, what's that old saying? Past does not equate to the future, something like that. Anyway, so the question becomes, when the yield curve normalizes, which will probably be within the next few days to weeks, will history rhyme with another recession in the next 2 to 6 months for the USA? You know, some point in 2025, early 2025, March, April 2025. Now, before we get to that, I want to take a quick moment to let you know about the Wealth Mastery newsletter. This is your weekly guide to the cryptocurrency markets. Our readers love it. I'm sure you will too. And here is why, because every single week, my team of researchers and we help you not just stay ahead of the curve, but also to save your time by finding you the latest, the greatest insights on altcoins, meme coins, DeFi, airdrops, charts, and much, much more. You can join our 140,000 plus weekly readers for free. A link in the description or the pinned comment over on X. So, is a recession coming soon? Well, from everything I'm seeing, it appears that the answer is probably, maybe, no, probably a maybe. Shit. Let me be frank, guys. I'm 50-50 at this point. Steel manning the bears for a moment. I suppose the strongest point is simply the fact that the damn yield curve has nailed every recession in the past 45 years. That's a strong nailing rate, isn't it? So to bet against it feels very counterintuitive. Moreover, some of the Fed's own yield curve modeling suggests a 50% chance of a recession from now through at least May 2025. JP Morgan's putting that at 45%, Goldman Sachs putting it at 35%. Second, the unemployment rate is continuing to grind up, down, up a little bit, and then down. Look, if the unemployment rate continues to go up, that's a pretty reliable indication of a coming recession, even if other data points have been good, and we'll get to those in a second. And third, just scan the news for all the other fun events, right? We had a big market crash this week. The Japanese yen carry trade unraveled, although the Bank of Japan quickly reversed course. They capitulated almost immediately. So maybe it's nothing to worry about for now. Iran, they're out there. They're throw the gloves off. We're going to punish blah, blah, the world. And then cooler heads kind of prevailed. Nothing really happened. So yeah, look, things aren't looking too great if you watch the news all the time. But turning to the this time is different case. I know most dangerous words in investing. I get it, but still, let's talk about it. First, we're in an election year, and something tells me that Papa Powell will do just about everything possible to stave off a recession until at least after November 5th. Bitcoin to $150,000 by November 5th, and then new Great Depression. Fire up those money printers, baby. Let's go. So maybe that alone buys us a few months. Don't forget, too, the Treasury Department in the USA is buying back $50 billion in treasuries between now and the election. Couldn't have anything to do with the election, I'm sure. Second, the US GDP, the very measure that determines a recession, just continues to charge north. In spite of everything else, the US economy just keeps growing. There's no signs of it even flattening out. Now explain to me, please, how are we going to get this massive recession, Great Depression, with continued positive growth in the economy? And if that starts trending down quickly, that's a different conversation, obviously. Third, a Trump victory in November might be somewhat of a bullish catalyst for the economy. Trump, at the time of recording, still has an edge on Harris, according to Polymarket. Moving back and forth, but look, that lead is narrowing fast. So this is where I'm at, guys. Recession in the near future is a bit of a coin toss in my book, right? Oh, shit. Anyway, look, to wrap up, if we do hit a recession, what's it all mean for our Bitcoin and our crypto bags? Well, as an aside here, this topic probably deserves a pretty thorough examination. So do let me know in the comments if you'd like me to do a video on how to best prepare for a possible coming U.S. recession. Having said that, my sense is that an official recession might trigger a fairly aggressive decline in cryptocurrency market prices. Doesn't mean crypto's going anywhere. Any market crash has always never meant that. But there will be blood in the streets. There'll be pain. There'll be weeping and gnashing of teeth. Prepare, right? The real question is, for how long and how bad will it get? And of course, what are you doing to prepare for that? You see, the Fed seems determined to keep the U.S. out of a recession. Will they win? Hard to say, but they're trying. So I think they'd probably at least try firing up the money printers to stimulate things a little bit, but we'll see. Maybe they'll wait until recession's actually here to do that. Whenever that does happen, as they always tend to fire up the money printers, that'll probably mean the markets will pump, even if they dump short term because of a recession. Bitcoin has been through only one big recession in its lifetime. It kind of came to birth in a recession, but besides that, anyway, the COVID recession in early 2020, Bitcoin puked by like 50% of its value in the span of a month, 50% a day, basically. But this also served as one of the most epic wealth accumulation events of the crypto market lifetime. So there's that. Be prepared for it. Before you could blink, Bitcoin had recovered to its prior levels. Then the 2020 supply shock hit and was off to the races. And if the recent Japanese-led sell-off is any kind of indication, then Bitcoin is something that will not be kept down for long. So another recession hitting this year or in 2025 might serve as another big opportunity. How long the recession is could be short and shallow, or it could be a new Great Depression. Everyone's always saying new Great Depression. Hearing that since I'm a kid, right? Thus, if the yield curve is right again, and as history suggests it probably will be, perhaps having some dry powder on the side to scoop up that inevitable Market chaos will prove profitable in the long term. Just remember, though, if we get a great rally in Q4 this year, take some damn profits, especially on those altcoins, guys. Because if we do get a market dump because of a recession, say goodnight to your altcoins, man. They're going down bad. Okay. Keep that in mind. When the markets are good again, we're looking maybe hopefully Q4 is going to be some great times. You got a lot of stuff, a lot of money printing coming up, rate cuts coming, elections. There's a lot of things that could get very exciting for markets. And during that time, you'll probably start feeling some greed, some euphoria. You're a genius. You're doing so well. Look at what just happened with Japan. Look how fast markets turn, how fast things dump. You've got to be merciless with taking those profits, taking money off the table, getting your capital back out, putting money in your pocket, paying yourself. Doesn't mean you can't keep moonbags. Doesn't mean you have to go 100% out of the market. But if you never take any money off the table, when the dump comes, you're going to be in a bad situation. Whether that comes soon and the yield curve is correct and that comes soon, or whether the yield curve is not correct this time and it comes later than expected, there's always going to be another recession. They're always just around the corner. The only question is how long it takes to get to them and how bad they are. Thanks for watching.